Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darcy here to bring you the daily recap. So the market looked today like it might put in a nice red dog reversal, the classic pattern we talk about all the time, and maybe put in a short-term bottom that could lead to a tradable bounce. But momentum petered out into the close. We ended up closing weak. So in this situation, we talk about how red dog reversals can either lead to short-term cash flow type trades or they can lead to more swing type inflection points. And it looks like for now this one's going to only lead to a little cash flow trade there in the morning as, like I said, momentum came out of the market in the afternoon and we closed weekly. We'll go and take a look at the chart to give you a visual of that. As you can see from this topic, this tail right here, we traded down below previous day's low, back above it, came back above the 8-day moving average. Thought this might lead to a little bit of a short-term complexion change after the 3-day slide. But then, like I said, we closed weak back near yesterday's low. So, not anything to write home about from the bullish side. The market looks like it still could continue to dribble lower. The 21-day moving average will be the area that people will be watching now to see if we can get some sort of bounce there. We have worked off our overbought condition and gotten into more neutral territory, even entering a little bit oversold territory in the short term. So people, I think right now the mindset is a little bit more to look for a bounce, but there's definitely not any hurry right now. And in general, you talk about the potential for a top in the market. Everybody's been looking for a top in the market over the last year or so. This year, there's been several moments where we've had 3 to 5% pullbacks, and people have talked about how, oh, this is it, this bull market run is over. We've continued to push higher, but then you haven't really had that sort of blow-off top up to this point or up to last week's point until that announcement last week that you saw with the Fed QE no taper. That's a little bit of a bold call, and I'm not ready to really put my neck out there and say we have topped. But if you're looking for a top for a multi-year massive bull market, you want one that's a little bit loud. You want one that's a blow-off top, a capitulation type top that really jumps out at you and says, wow, this market's getting a little bit out of control. And last Wednesday when you got that no taper announcement, everybody was sort of up in arms because it was a really surprising announcement. The market just rocketed higher. There was none of those fakes that you see on Fed Day. You didn't see up, down, up. You just saw market up, up, up. You saw gold ignite. You saw all these things ignite. And then since then, you've really seen everything, the air sort of come out of a lot of sectors. You've seen some frothy sectors, some frothy stocks sort of get trimmed a little bit. And you've seen various sectors, you talk about the financials, for example, be really weak. There's just a lot of internals in the market right now, in addition to some frothy stocks that are getting haircuts that are telling you that things are not really as healthy as they has been for much of 2013. But I'll go into a few charts to give you some examples of that. The XLF is one thing I talked about that hasn't been such a loud sell-off from the XLF, but it's just sort of been lagging the market for the past few months quietly. And those stocks really haven't been on our radar. We've been focusing heavily on tech. And in the background, the XLF, the financials have been weak. And then talk about relative weakness over the last 4 days. You can obviously see that here on the chart. And the market itself hasn't been all that strong, but you see the XLF now below the 8-day, 21-day, approaching the 100-day moving average, obviously showing relative weakness. All those are curling down now. This ETF looks like it's ready to test eventually this pivot here. It's around 1935 based on the look of this chart. There's really not much in the way of support until that area, except for in the short term I could see some support coming in here at the 100-day and the round number of $20. But in general, I think this is one that is showing relative weakness, and I think will continue to show relative weakness based on the recent technical action. The GLD was another thing that was sort of a interesting case after that Fed QE no taper announcement. Is that you saw this huge igniting bar. You saw magazine covers and mom and pop talking about the new bull market and gold, and everybody was all up in arms about that decision. But then what do you get? You get that huge igniting bar, but then we've given back every single bit of those gains. Today we were able to, after the big gap down, trade up and basically close flat on GLD, but that's not the look of a chart that wants to go higher. You have maximum full-fledged QE in place. They announced they're going to keep it in place, and still gold's not able to sustain any sort of multi-day rally. It gives back all the gains from that initial euphoria. And just like the market, you could talk about a potential blow-off, capitulation, euphoric type top. You could talk about, obviously it's not a top in gold, it's come off significantly, but that's sort of a dead cat, euphoric type dead cat bounce. and it's one that looks like it's headed lower to me. So that's just an example of how euphoria was very short-lived on that QE no taper announcement. And then you talk about TLT. Bonds are coming back in vogue. There was this talk about, yields are going to go higher and bonds are going to sell off. And we did get a big sell-off in bonds, and that's what people fail to realize, is people were getting greedy with that direction of the bond trade after, we really did get a big down move in bonds, and yields hit almost 3% on the 10-year. They dipped above 3% there briefly. But then you're seeing a break of this downtrend. You talk about pure technicals. You can apply technical analysis to almost any asset. That's not the line I want. You can apply technical analysis to almost any asset. You talk about currencies. My line tool is not working well for me right here. But you can do it with fixed income. You can do it with currencies. You can do it with stocks. And you can see clearly there's a big downtrend in place that started back in April when the taper talk started that's getting broken. And that tells you that we could see a sizable bounce in the TLT. Yes, maybe rates eventually are going to go higher, but there's a lot of dovish comments coming now from Janet Yellen, the presumed next Fed chair, Bill Dudley, the head of the New York Fed, and then Ben Bernanke, who's still the thought leader of the Federal Reserve. All those people are coming out now, changing their tune a little bit from what we heard for a lot of the summer about potential tapering and how the economy is improving to the point where policy can become a little bit less accommodative. And from the sound of it, there's not really too much of a firm eye cast towards tapering right now. I think they're looking to mitigate some of the negative effects from some of what's going on in Washington, the potential government shutdown, all that type of stuff. So, people talk about maybe a December taper. If not December, it's going to go into 2014, obviously. So you could see things that could allow bonds to continue to tick up as people look for that low-risk type return, even if the return isn't all that spectacular. Then getting into some more stock-specific type stuff, which I think, we talk about sector analysis and looking at indices and looking at commodities and using that to gauge trends on the market. But when you're talking about actually putting money to work in the market, I think you have to take a very stock-specific approach right now, because that has continued to be a lot more rewarding than trying to, pick tops and bottoms in the indices. And one stock that continues to reward people on every time frame that we've been focusing heavily on in our newsletters and our videos on the virtual trading floor, Facebook, obviously, big news in the market today. Facebook in China, they said that they're going to not have full censorship in Shanghai, the free trade zone of Shanghai. They're going to allow access to Facebook and Google and New York Times. So a little bit of a step in a freer direction in China. And obviously Facebook is one of the things that's going to be allowed to be accessed there, and that's a huge market that's untapped for Facebook, the largest social network in the world, that isn't even priced into the stock. So a big jump today on that news. It did have a little bit of a doji candlestick, closed well off its highs with a little bit of a topping tail there. That tells me that short term it's a little bit exhausted after this really impressive price action. The latest clue that Facebook was ready to get back in motion to the upside was this king and queen formation, when you have a big igniting down move that tells you, all right, perhaps momentum's going to come out of this a little bit. And then the next day you have an engulfing bar that engulfs that entire previous day's range. That is an extremely bullish pattern, tells you there's more upside. And what do we get? We get a new breakout to all-time highs. But now we're a little bit short-term overbought. Could use a pullback into this, to fill this gap, or even the 8-day moving average, which is trending up now with this recent bullish price action. But Facebook, tremendous stock. We've talked plenty of times. I've talked about on video. Scott's talked about. We've talked about in Off the Charts about how this one's destined at least for the 50s. It looks destined for the 50s after that earnings gap and go. Great opportunity to buy the dip at 36, which is one we highlighted again really heavily on Off the Charts. So this is one that I think you continue to trust on pullbacks, and I think it's going higher with everything they have going right now. LinkedIn, impressive comeback today, sticking around with the social networking stocks. LinkedIn was one that we noted some extreme weakness in over the last 3 days, looking like it could potentially break. It dipped below this pivot right here low around 237.22. Looked like it could be headed for more downside, but then closed well off its lows yesterday, which told you that some of the short-term downside momentum was gone as dip buyers stepped in, and it led to today a really nice bounce back to above the 8-day. Like yesterday, it closed off of its lows. Today, it closed off of its highs a little bit, which tells you maybe it could trade in a little bit of a range here for a period of time. But overall, a nice, impressive comeback from LinkedIn tells you that the social networking space is healthy. When dips are getting bought, when people are looking to buy dips near moving averages, that tells you the institutions are still looking to get involved. If they get a more attractive price, they're even more inclined to get involved. So really nice, impressive action here. There's nothing to tell you that this one's headed for any extreme downside or anything like that. And then all the buzz about the Twitter IPO is looking like it's going to be in November. It's going to be listed on the NYSE. I don't know why they would choose not to list it on the NASDAQ after the great success they've had with recent IPOs. That's sarcasm if you didn't get that. But there'll be a lot of buzz surrounding that, which could have some residual impact, positive impact, I think, on Facebook and on LinkedIn. And then talk about Apple, another big name tech stock. Apple's sort of been all over the map recently with the release of the new iPhones and then the corresponding sales figures for those iPhones coming in, all kinds of conflicting reports from different bloggers, and then you get it from the horse's mouth, and you get all these conflicting reports that have led to a lot of gaps and a lot of really tough action to trade, to be honest with you. First, you had that product event where they didn't announce anything too groundbreaking when people were expecting maybe a little bit more. Big gap down on that. I talked about how I thought this gap down was a little bit of an overreaction. We got a bounce the next day, but then we traded lower again. Found support at the 100-day moving average, bounced back up. And like I said, it's been really erratic type action. On this engulfing day, this is a really bearish candlestick. When you gap up and you engulf the entire previous day's range and then close the gap from the day before that, that tells you the stock looks like it might want to go lower. But when you have headlines, when you have news in play, it can throw everything for a little bit of a twist, and that's what you got with Apple. The demand for the iPhone seems as healthy as ever. 9 million iPhones sold in the first weekend, so those figures were able to boost Apple for a nice gap up. But yesterday during the session, it was weak. A lot of that gap got filled. It did close off of its lows like some other stocks in tech, but not the type of action you want to see if you're a bull. And then today we open higher again and trade down during the session. So not the ideal action for Apple bulls. Yes, it is sort of finding its way higher, sort of finding a way to win ugly, to use a sports analogy. But if you're trying to trade it intraday, this is not the type of action you want to see. I think you're best served to look elsewhere. Google is a case. This was Mark Sperling's trade idea of the week on Monday. Didn't have nice price action yesterday, obviously. Really bearish move, like you saw in a lot of tech yesterday. And today it put in a little bit of a doji candlestick, which is a candlestick of indecision, telling you that Google right now is sort of in wait and see mode to see what its next move is going to be. A doji candlestick can oftentimes pause the recent short-term price action in anticipation of a potential reversal of that price action. So you could say that today stemmed the tide of yesterday's selling and is potentially basing for another move higher. I tend to be very bullish on Google. I think the company's outstanding. They have their core search business. Last week they announced a new initiative that's going to try to defy death. They're taking on aging. They're going to put a bunch of money into one of their moonshot projects, as they call it, speculative project, where they're going to do some research on how to reverse the effects of aging. So obviously a very different thing than they're normally involved in, but could down the road have a big impact. And I think Wall Street investors love the potential of Google with all those far-reaching projects. And what their business is now is probably a fraction of what it's going to be in the future in terms of the scope of their business, even though they do a lot of things now. But self-driving cars, anti-aging, Google Glass, all that type of stuff has enormous potential. So I think people, and I am very bullish on Google. That's a long-term perspective. Short-term, like I said, still above the 21-day moving average. Doji candlestick today. I could tell you that it could get back going to the upside here in the near future. Talk about Tesla, one that I talked about how some froth was coming out of some of the frothiest of the tech sector. And that's not the case in Tesla. It does have some very brief pullbacks, but almost any time it tests its 21-day moving average, it bounces. As you can see here in July, it broke below its 21-day for the only time this year, immediately climbed back above it and climbed back above the 8-day in the same day. So it tells you whenever there's a dip, huge buying interest. Again, came back to the 21-day, bounced off it impressively, made new highs. And then early September, we got another almost retest of the 21-day EMA, another move back to highs. You could call this a bull flag forming up here. So you just use the pivot highs, the all-time highs as your buy trigger. As a conservative entry, you could be involved in the flag if you wanted to for a little more aggressive entry, but this is one that might need a little bit of rest before it's a compelling long again, but still heavy short interest, still a lot of momentum. Even though the CEO thinks it's a little bit overvalued, Elon Musk comes out and he's super honest, says that it hasn't really done all that much to justify the current valuation. The stock still pushes on and still makes new highs. So that tells you just how much strength this stock does have. Pandora is one that I talked about Friday. If you follow me on Twitter, at DarcyT3Live, this is one that was exclusive to Twitter because it's just something that I noticed based anecdotally and based on the chart. And this is one that I think I've never really believed in the Pandora business model. I think it's so ripe for competition. Yes, they have advertising in between their songs that they stream, but in terms of a viable long-term business, I just felt that it was so ripe for competition that it would be tough for it to justify the valuation. And that was when it was a lot lower than it is now. And it even had a secondary offering, shrugged that offering off. And you wouldn't say it necessarily went parabolic if you go back to the chart. But you see this really bullish price action in Pandora after a secondary offering, which is impressive on the surface. But then what happened when I talked about anecdotally, my thesis on this one was everybody downloaded the new Apple operating system over the weekend. And one of the things that was a default on that operating system is the new Apple iTunes Radio. And I tried that out. It's basically a replica of Pandora, the exact same thing. Other services offer it too. Spotify has a radio, but I thought Apple's was really good. I thought they did a really good job with it. And the ease of use in terms of integrating it with all your other devices, with all those iPhone users out there, it's a no-brainer to me that I'm going to not use Pandora anymore. I'm just going to use the Apple iTunes Radio. And I thought that that was going to be a narrative that was going to get an increasing amount of press in the coming weeks. And I think that happened over the weekend. So in addition to the stock being a little bit overbought and a little bit frothy, to use that word again, there was definitely a news catalyst to the downside. So on Friday at about 11 a.m., you go back to the chart, on this doji candlestick, I said, is it just me or is there definitely cause to think that Pandora might get absolutely crushed here? And I even when it closed off its lows after the close, I said I still think Pandora is going to get hurt at these levels. And then yesterday you had about a 10% drop in Pandora, so obviously a healthy down move there. Today it was able to find its footing a little bit, but on any significant bounce in Pandora, I really would much prefer to be short this stock. I think it's headed a lot lower. Like I said, I had a secondary offering, surged off that secondary. They said they were going to use some of those proceeds potentially to make some strategic acquisitions, but like I said, I think this one was so ripe for competition. The Apple iTunes Radio might eat into its market share significantly, and I think it's a cause for concern definitely for Pandora that might not show up until 1, 2, 3 quarterly earnings reports from now, but definitely something to keep an eye on. So if we do get a bounce in Pandora, I think it's something you could look to short. Just going around a few more stocks that have been in play. The 3D printers have obviously been hugely in play. Mike Lee, Steve LeVay focus heavily on them in their Trade the Open mentoring room because they provide great volatility. There's sort of a haves and have-nots type situation with the 3D printers right now. Triple D continues to get upgrades. New firms, new analysts keep coming out and initiating coverage on it, all with buy ratings, it seems like. So people are really bullish on Triple D. All time frames aligned to the upside. So this is one that closed a little bit off its highs today. Not exactly what you like to see, but really bullish price action there. If you're a short-term trader, this one, like I said, providing great range, great volatility. Baidu is one. People have been watching the Chinese internet stocks have been heavily in play. This is another one that looks like short-term needs a little bit of a rest after a really nice run since July with that topping type tail. Not a loud topping tail, not a huge engulfing bar or anything, but when you get a big wick like that on a breakout, not exactly what you'd like to see. Could lead to some short-term rest at the very least. Zillow is one people have been keeping an eye on, another one of those frothy internet names that took a little bit of a haircut over the last few days after that whole Fed fallout. And a lot of people on the virtual trading floor today were looking for a potential bounce in this off this moving average. It did early. It looked like it was going to reclaim most of yesterday's losses, and it did reclaim most of yesterday's losses, but then closed well off its highs. So once again, not really a lot of commitment to the upside right now. I think people were a little bit disgusted. Disgusted might be a strong word, but they're a little bit fed up, to use a pun for you there, about what's going on at the Federal Reserve. They spent the whole summer sort of setting the market up for QE tapering. They set the expectations. They tried to talk the market down a little bit, get people prepared for a higher interest rate environment, and they did that. They did it effectively. Everybody was ready for it. The market was at all-time highs just about. It was just off highs and still expecting QE tapering. So that was a really healthy thing. The market was standing a little bit on its own two legs. And then they came out. They didn't taper QE when they had a really good chance to. October, they're going to be in the middle of the debt ceiling, the budget fight, the potential government shutdown, that whole debacle. They're not going to want to taper then because that's just going to add to the potential turmoil in the market. December, you're around the holidays. The thought is they wouldn't want to taper around December 20th, around that is the next the Fed meeting after the October meeting. So you could see easy money in QE and all the unintended consequences that come with QE stretch into 2014. And I think this whole quantitative easing experiment is just that. It's an experiment, an unprecedented experiment on unprecedented levels. And I think it causes a lot of anxiety for the market. And despite the fact that it's been bullish for stocks, like I said, it's caused a lot of anxiety for investors. They're sort of looking over their shoulder to see when they should be selling. They're looking out for the next doom and gloom article about the next October 1987 crash. I was born in October 1987, so maybe I was destined to be a trader, but just an aside there. But anyways, people, like I said, a little bit anxious, and the higher you go, the more fear of heights you're going to have. And I think we got that sort of euphoric top in the market. Who knows if it turns out to be a longer-term top, but definitely some weak action in the market right now as people wrestle with the implications of more QE. But the QE is having diminishing returns. You had the first round of QE, everyone said, wow, this is this new inventive policy tool that you can't fight the Fed, you got to buy QE. And then QE2, wow, they're going even bigger after. Then QE3, open-ended QE with large purchases every single month on an open-ended basis. Wow, this is really going to be huge for the market. Obviously in 2013, it has been huge for the market. Now everybody was expecting us to head in the other direction, and it almost felt like that decision not to taper was another round of QE, but it had a very short-term impact. And when you have something that is very extreme, the first couple times it comes, it can have a big impact. But then, like I said, law of diminishing returns. We could be headed down now, despite the fact that QE could continue until 2014. But anyways, it's been a long daily recap. Sorry to get a little bit long-winded. I get my chance in front of the camera when Scott steps away. I like to share a little bit of my thoughts, a little bit of my different perspective. Hope you appreciate it. And Scott will be back here with Brittany tomorrow for the morning call.